Why are grocery stores shrinking while prices keep rising? Walk into a supermarket today and the math feels broken. The sack of chips is lighter. The ice cream tub is shorter. The cereal box is narrower. The receipt is longer. This is not random inflation. It is a design choice. The industry calls one version of it shrinkflation. Less product. Same looking package. Higher effective unit price. Your brain notices the shelf tag slower than it notices the big red sale number. Here is the first mechanism. Grocery is a brutal low-margin business on paper. Supermarkets often live on roughly 1 to 3 cents of pure profit per dollar of sales. When wholesale costs jump, raising the sticker price too fast makes shoppers revolt. Shrinking the package raises the real price more quietly. That is the psychology. People track the number on the shelf more than the ounces in the bag. A family remembers paying $5 for chips. They do not weigh the bag every week. If the fill drops from 11 ounces to 9 while the tag moves from $5.50 to $5.99, the store wins twice. Higher unit price. Lower resistance. The second mechanism is footprint. Stores are not only shrinking product. Many are shrinking physical space strategy. Big traditional supermarkets competed on massive assortment. That creates inventory cost, spoilage, labor, and complicated shelves. Smaller format stores and tighter category choices / complexity. Dollar formats and limited assortment grocers proved the model. Fewer SKUs. Faster restocks. More private label. Higher turns. Aldi-style operators wrung efficiency out of every square foot. Legacy chains watched and copied the bits that protect margin even if they still look full size from the parking lot. Inside the bigger chains, aisle real estate is a market. Brands pay for placement. End caps are auctioned. Eye level is rented with money and discounts. That means the products yelling at you are not always the products priced best for you. Placement is funded. Visibility is a cost center with a sponsor. Private label is the other quiet machine. Store brand used to mean cheap filler. Now it is often the profit engine. Chains use national brand ads to pull you into the aisle, then park their own brand one shelf lower at a better margin. When national brands raise prices, private label gains share without the chain needing perfect brand loyalty. Look at the unit price label and you will see more. Ounces and each pricing are weapons. A multipack can look cheaper while costing more per ounce. A warehouse club box can win only if you finish all of it before it spoils. Waste is the hidden fee shoppers pay on oversized value packaging. Labor and spoilage push the same direction. Fresh food damages margins when stores overstock. One response is tighter inventory and more prepackaged formats. Another is dynamic markdowns near closing. Both reduce pure abundance marketing and increase controlled scarcity. Delivery apps add another twist. Customers compare a $20 delivery fee and tip stack against in-store frustration. Grocers invest in online staging, third-party marketplace fees, and dark store-style fulfillment. Those costs land somewhere. Sometimes in delivery pricing. Sometimes in shelf pricing for everyone. So why do prices keep rising even when a headline says inflation cooled? Because grocery pricing is sticky, category by category, and because input costs do not reverse symmetrically. Diesel can fall. Cocoa can spike. Eggs can crash then rebound. Graphics on nightly news flatten a storm of different curves into one shopping cart. Your cart is not the average. It is a sample of the categories you actually eat. Retailers also know that high-low pricing trains loyalty more than everyday low pricing for many shoppers. Jump the regular price. Run a digital coupon. Make the customer feel clever for clipping. The club price becomes the emotional win, not the open price. That theater is old, but software made it sharp. What should a normal shopper do once they see the system? First, compare unit prices every time, not package pride. Second, treat private label as the default unless the brand actually tastes better for you. Third, use end-of-day fresh markdowns and warehouse clubs for staples that do not spoil fast. Fourth, stop assuming a bigger box equals better economics. The deeper lesson is this. Grocery is not failing because boxes got smaller. Grocery is protecting thin margins by moving decision friction onto the customer. When product grams fall and fees and surcharges elsewhere rise, the store converts confusion into cash flow. That is real-world economics. The shelf is not only a place to sell food. It is a carefully engineered interface between limited attention and commercial incentives. Once you see that, the smaller cereal box stops looking like a mystery. It looks like a strategy.